Oil investing? Isn't that old news? Not even close. In the next few minutes, I'll give you a quick history, why oil still matters, the main ways to invest in oil, and the risks, so you don't blow up your portfolio. Oil isn't just some sticky black liquid. For over a century, it's been the lifeblood of the global economy, powering cars, planes, factories, and even the plastics in your headphones. And despite the focus on green energy in recent years, oil is still the world's most dominant energy source. A brief history of oil's role. The modern oil story begins in the mid-1800s, when the first commercial oil well was drilled in Pennsylvania. Oil quickly became the fuel that powered the next stage of the Industrial Revolution: cars, ships, and airplanes. By the 20th century, oil wasn't just an energy source, it was a geopolitical weapon. World War II was partly won on oil supply. The 1970s oil crisis? It sent shockwaves through the global economy and pushed prices through the roof. Back then, controlling oil wasn't just business, it was a golden ticket to power, the kind of power that makes presidents take your calls. Why oil still matters today. Oil is still the world's #1 energy source, making up about 32% of global consumption. Even with all the buzz about renewable energy, oil remains versatile, energy-dense, and deeply woven into industries that green tech hasn't replaced yet. Think about the fuel in planes that connect continents, the diesel in trucks delivering goods, and the raw materials for plastics, chemicals, and even your smartphone components. Green energy is the future, sure, but oil's the present you can't ignore. Like a stubborn ex, it just won't quit. Ways to invest in oil. So how do you invest in oil? There are several ways. Let's go through them. Oil stocks. Shares in companies that explore, drill, or refine oil. Examples include ExxonMobil or Chevron. You get growth if oil prices rise, but company troubles can hit your returns. Oil ETFs. Funds that bundle multiple oil-related stocks or futures contracts. Great for diversification without picking individual winners. Physical oil. Yep, you can literally buy barrels of oil. Not very practical for most investors, but an option if you like a hands-on approach. Derivatives and leveraged instruments. Futures, options, and CDSs. These let you bet on oil prices up or down, often with leverage. High risk, high reward, and usually for advanced traders. MLPs, master limited partnerships that invest in pipelines and infrastructure. Offer steady income but come with unique tax rules. Risks of investing in oil. Of course, oil investing isn't without risks. First, price volatility. Oil prices can swing wildly due to geopolitics, OPEC decisions, or global demand changes. One day you're up, the next day, not so much. Next, company risk. If you own stocks, the company could face operational issues, debt problems, or regulatory fines that hurt your investment, even if oil prices are high. Then there's geopolitical risk. Wars, sanctions, or political unrest in oil-producing regions can send prices soaring or crashing. Finally, environmental and regulatory risks. New laws, carbon taxes, or shifts toward renewable energy can impact profits, especially for traditional oil companies. The key? Diversify, understand what you're buying, and always factor in the risks before jumping in. Conclusion on oil investing. Oil has shaped history, powered economies, and it's still the #1 energy source today. For investors, it offers opportunity, but also big risks. For most people, a balanced approach works best. That could mean holding oil through diversified stocks or ETFs, rather than betting everything on crude prices or complex derivatives. So if you want exposure to oil, invest with strategy, not emotion. This is Baron the Bull with Bulls, Bears, and Money. If you found this useful, hit subscribe, and I'll see you in the next one.